July the 1st changed how your superannuation gets paid, and it arrived with no form to sign and no notification on your phone. Money now lands in your retirement account on a different clock than it did in June. Most people will not notice it at all. The problem behind the change is worth more than $6 billion in a single year, on the Australian Taxation Office's own estimate. Superannuation guarantee is the compulsory contribution your employer has to make on top of your wages, currently 12% of what you earn. That rate has not changed. What changed is when it has to arrive. Under the old rule, an employer had to get that money into your fund within 28 days of the end of a quarter. Work through January, February, and March, and your employer could hold the super for that entire stretch, then pay it by the 28th of April. Nothing about that was cheating. That was the law working exactly as written. From the 1st of July, contributions have to reach your fund within 7 business days of the day you get paid. Miss that, and the super guarantee charge applies, which is the penalty the tax office imposes when contributions land late. 2 other things moved at the same time. The calculation base widened to a new term called qualifying earnings, which pulls in all commissions and salary sacrifice amounts on top of ordinary wages. And super funds themselves went from 20 business days to allocate your money down to 3. Take someone on $90,000 a year, paid fortnightly. 12% of that is $10,800 of super across the year, about $415 a fortnight. Under quarterly timing, a contribution she earned in the first week of January did not have to reach her fund until the 28th of April. The dollars were not lost, they were late, and late money does not compound, because it is not in the market earning returns. Treasury put a figure on what that lateness costs. A 25-year-old on a median income shifting from quarterly super to payday super ends up around $6,000 better off at retirement, or about 1.5%. That is the compounding alone. Same wage, same 12%, same career, different timing. Underpayment is the other half of the story. The tax office publishes an estimate of the gap between the super that should have been paid and the super that actually was, and for the 2022 to 2023 year, it put the net gap at $6.2 billion, or 6% of everything owed. What makes that figure land differently is how the tax office found it. They run something called a random enquiry program, where employers are selected at random rather than flagged as risky. 668 audits and reviews went through it. 41% needed an adjustment, and the median correction was about $8,000. The quiet part of the old system is that holding your super for up to 4 months was free working capital, and it was entirely legal. A business paying super quarterly had that money sitting in its own account in the meantime. For a firm with a large wage bill, that is a meaningful cash flow buffer, arriving by design rather than by anyone's decision to exploit it. Quarterly deadlines were not built to create a float. They date from an era of paper forms and monthly bank runs, when asking every employer to reconcile super on every single payday was genuinely impractical. The incentive showed up anyway. A deadline 3 months out is a deadline that rewards waiting, and a business under cash pressure can use every day of it. Super funds had their own version of the same thing. 20 business days to allocate a contribution is close to a month where the money exists but is not yet invested in your name. That window has now closed to 3 days. Your payslip is where this shows up first. Super should now appear against each pay period rather than in a quarterly lump, and it should reach your fund within 7 business days of payday. New employees are the main exception, with 20 business days for that first contribution. One part of the change cuts the other way, and it is worth knowing about. The super guarantee charge used to be non-deductible, which made it bite harder. From the 1st of July, it is tax deductible, and the penalty on top moved from a maximum of 200% of the charge to 25 or 50% of the unpaid charge. Interest, though, now compounds daily instead of sitting at a flat 10% a year, and the tax office assesses the charge itself rather than waiting for an employer to self-report. Whether that adds up to a tougher regime or a softer one depends on which lever you weight. If your super looks wrong, the tax office runs the unpaid super process, and that is where the question goes. Anything about your own contributions and what they mean for your position is a conversation for a registered tax agent, not for a video. Step back from your own payslip for a moment, because the part of this that seems unresolved has nothing to do with any single employer. What follows is opinion. $6.2 billion in a year is a number the tax office can already produce, and 41% came out of its own random sample. Both are published once a year, aggregated nationally, roughly 3 years after the fact. Our reading is that the more useful version would be narrower and faster. The incidence rate broken out by industry, published every year alongside the gap. A worker in a sector sitting well above the national 41% would learn something real about the market they are in, and so would the regulator. The data already exists inside the random inquiry program. Only the granularity of the reporting is a choice. Timing was the thing that changed here, not the 12%. Which raises something worth arguing about below. Was quarterly super ever really a practicality problem, or did it survive for 30 years because the people it inconvenienced were not the people paying for it? Tell me where you land.